So if we throw 25% at it, if we throw 50% at it, if we throw 75% at it, and in practice for this coin toss game, the optimum for the maximum profit is around about 25% for a system with a 50-50 win-loss ratio of this sort. As you can see, once you get to 50%, you'll actually come out about break even. The effect when you get a drawdown, when you've thrown 50% of your capital at it, is so severe that it's very difficult to recover. And even though your profits are exponential, once you start recovering, the drawdowns are so severe that you'll end up around about break even for a 50% ratio on this particular system. And if you go higher than 50%, then you'll actually start to take a loss. Now in this case, it might surprise you, it doesn't matter what order those trades come in. I'll just show you very quickly that if we have the 5 wins up front, and then we have the 5 losses towards the back, the profit numbers stay exactly the same. So the ordering is totally unimportant in terms of the gross profit. It does affect over the right hand side. I've thrown in some drawdown calculations, so drawdown is a bit more random, but the interesting thing is that the gross profits for this style of system are the same regardless of the ordering. Now this is an interesting academic exercise, but we'll go back to we'll turn this into some more practical considerations in just a moment. Now let's just go back to the slideshow. As you can imagine, if this is just a graph that roughly shows what happens with your account equity growth over time, and you can see that, well, you might be able to see there's three bars there which indicate the account growth. If you get your expectancy, your 50 cents per bet expectancy over a long period of time, if it's 2% that you risk, it'll grow a certain amount, 5%, 10%, 25%. It really starts to go exponential, and this is the key. The growth of your account is going to be exponential because you're compounding. When you're using a fixed fractional method, you're compounding your growth rate. So your growth rate's going to be growing exponentially. This is another way of looking at it. Across the top we've got a graph that simply shows if you risk 1%, 2%, all the way through to 27% for this coin tossing game, you can expect that your end equity at the end will be shaped like that. As you can see, if you start to allocate numbers like 11, 12, 16, 20%, your end equity is starting to grow exponentially. But you can see in the bottom graph that your drawdown is growing linearly, and this is the key in a sense, in that as you throw more risk at a system, your potential ending equity will grow exponentially, but your drawdown grows linearly. So all else being equal, and you can stand the drawdowns, then you need to allocate a good amount of risk to it, sufficient to achieve your objectives. As I said, you have to be able to live with the particular drawdown. But what we're going to do is get to how we choose that happy medium between good equity with reasonable drawdowns. So what we're going to do for the rest of the presentation is try to zero in on that % risk figure which is optimum for your particular system. Now there's a couple of ways to do this, but we'll start out with the simplest. For the simplest scenario, we need a couple of statistics from your system. You need your average win versus average loss ratios. So if you on your winning trades, if you win $2, your average loss is $1. So that's an average win to average loss ratio of 2 to 1. If you're scalping, you might well have an average win to average loss of 1 to 1, for example. All sorts of systems are different. The win percentage is the percentage of your trades that you actually do win. So a coin toss is a 50% ratio, a long-term trend follower might get 30 or 40% win ratio, a scalper might expect to get 60 or 70 or 80%. And the other figure is expectancy, and that's simply whether your system expects to make money over the long term. The profits outweigh the losses, basically. And the question is whether you've got these statistics for your current systems, or you've got a trading track record where you can get those figures. Without these sorts of things, you can't do any of this sort of analysis, and subsequently you can't really attempt to allocate an optimum amount of money to your systems. Just a word on expectancy. If you've got a bad system where the losses outnumber the wins in terms of gross loss and gross profit, then obviously we can't, with money management, turn that into a winning system. But if we take a winning system and then throw too much money at it, more than the system can stand, you can obviously turn that into a losing system. You can break your bank. We also have to recognise that you want a robust system which is likely to perform reasonably well in future, as it has done in the past. If you're looking to backtest a system and you've curve fit your data and so forth, then your future results probably won't look much like your past results, so that's a bit of a risk. So you have to be confident that your system is sound. It's got a sound concept. So we're suggesting that if you optimise your money management and get it right, it makes a difference between retiring with $10,000 in the bank or maybe $10 million, which is quite a difference. So you really need to get this optimal X figure as spot on if you want to reach your objectives. Okay, so here's the formula for a simple system. A simple system we define as one where all the wins and all the losses are the same size, like a coin toss game. If you're a scalper, you might set a stop loss of a couple of points and a take profit of a couple of points. So all your trades, the wins are the same size, all the losses are the same size. So in this case, the optimum amount, which will give you the biggest gross profit over a period of time, is a simple formula. It's P minus Q divided by W. P is the probability of the win. So if you've got a system with a 50% win ratio, then P is 50%. Q is 1 minus P. So if P is 50%, then Q is also 50%. And W is the ratio of the average win size to the loss size. Now, I notice a question there, whiteboard and application sharing. Is everyone seeing the slide okay? I hope so. So in the case of the coin toss game, that calculation comes out at 50% minus 50% divided by 2, because the wins are twice as large as the losses. So that just flows straight through. The answer is 25%, as we saw in the spreadsheet, which worked it through the hard way, actually calculating the profits and losses on every trade. So that's a simple system, and if you've got a system like that and you've got those stats, then there you are in 3 seconds. You can get a feel for the optimum risk percentage you can throw at a system to maximise profit. And we'll get to the practical considerations later where you have to take that with a little caution. But let's just move on to a comment about non-simple systems, and there's probably more of these than there are of the other type, where your wins and your losses are of many different values. There's somewhere in between your maximum loss and your maximum win. There's no standard mathematical formula that can be used to calculate that optimal figure. In the literature, it's known as optimal F, and you'll see some references to it in some of those books that I referred to earlier, or you can search on Google, etc., for optimal F. But basically, the way to find what this optimal figure is a little bit brute force, if you like. All we do is we take our system, we run it through a back tester with 1% risk or 2% or 5%, and we just run it through with each different value until we get to the value which peaks at gross profit. That gives us the optimal F figure. So we know what is the best X% number that we throw at a system to maximise the profit return from. Now, to help with this sort of thing, on the web page, which we'll give away later with the free indicators, we've also given the source code so that you can include